back to the Pulver Report. It is 9 o'clock on July 8th. We all had a fantastic weekend, possibly extended that with the holiday week, July 4th on Thursday. Markets at all-time highs on Friday. We're sitting here at pre-market, 555.17, up another 50 cents on the SPY. Take a look at last week's move. Finished the week green. It gets a little long in the tooth. We know that. We're overstretched. We're overbought. We're divergent. We have a ton of earnings this week, but it is noted 29 companies reporting earnings this week. Let me figure out. I think I posted that in Discord. I sure did. Right here. Let's go right there. There we go. Earnings this week. Some notables: Delta Airlines, PepsiCo, Conagra Brands, JP Morgan Chase, Wells Fargo, Citigroup, Bank of New York Mellon. So financials kicking things off on Friday the 12th. Big news for Thursday, Friday, US CPI, US PPI. We also have Jerome Powell testifying this week on Wednesday. So here's the Forex Factory calendar. We have Powell testifying on Tuesday and Wednesday. We have Chinese CPI data and PPI data coming out on Tuesday night. We have a cash rate decision or a rate decision from New Zealand. Expected to pause at 5.5% and hold. Curious if the statement will be leaning dovish or hawkish at all, what that looks like for price action this week from Tuesday to Wednesday. Powell's combo, Tuesday and Wednesday for testimony. Thursday, pound GDP, U.S. core and yearly CPI. As well as monthly, and then unemployment claims. I have a couple of interesting charts I want to share this morning. Let me also take a look at the chat today. All right, Jacob, good morning. David, good morning. Good morning, everybody. All right, I see everybody this morning. CPI on Thursday, PPI on Friday out of the U.S., U of M consumer sentiment on Friday as well. Here's a look at some stats I thought would be notable. Year to date, NASDAQ's up 24.29%, S&P up 17.38%, Dow positive 4.4%, but certainly underperforming. The Russell, I believe, is up 1%. The 10-year for the U.S. bonds, that is 10-year yield at 4.27. It's up 32 basis points. Bitcoin actually has had a huge tumble. We're at 57,000 off the highs at 73.8. Still up 35% for the year, but obviously way shy of some of the stocks that we've seen this year. Nvidia up over 150%. Some of your big rips, to the triple digits on some of the semiconductor plays. Tesla has had a massive rip in the last maybe 1 to 2 weeks, and we're just back to break even essentially on Tesla, which I thought was pretty interesting. So let's go here. Speaking of Tesla, here's what the chart looks like. Tesla, 1, 2, 3, 4 days. Just a monster rally. Tesla's up 25% in the last 4 days of trading to get back to what? 1% on the year. So, I do like this measured move. I've been watching Tesla to see if we have a head and shoulders, and it certainly looks to be that this seems to be the case. If we're going to have a kind of a self-fulfilling pattern, this low to high, we started to form right in this equal level. Not too bad on the technical side, 150, then rip up here, and the market is pushing. So I have symmetry measured a couple different ways. Tesla seen, measured 1. This could be a symmetry move towards around 337, and then a break of this neckline if we continue to see Tesla rip 466. So I will be watching that closely. I'm looking to get position on that this morning. I'm also looking to, buy myself some very inexpensive insurance on the portfolio, just in case we get a little sideways, maybe a little wobbly, maybe a little top heavy. This rip we've seen since October 2023, November 2023. Wow. I think we can all agree it's been pleasant. It's paid pretty well, up 35.5% with essentially zero pullback outside of our April correction. That's it. I mean, if you look at this starting move right here, April was the only real dip that we had, and this market is still fueled aggressively to the upside. Good morning, Willard. Chris, good morning. Marcus, good morning. Can you check gold, some yen pairs? Absolutely. Gary, good morning. Jay saying, I'm new here. Anyone know if Chris is qualified? If I've got any followers out there, you can give Jay a couple comments here. But Jay, you can also judge for yourself. Let's have a look at everything today. But I would say I'm qualified. I've been doing this for a long time, and yeah, you be the judge. But any other followers out there want to give Jay some comments? Feel free. Thanks. Okay, so like I said, opening bell in about 22 minutes. I will be looking for some inexpensive hedges this week, sitting here at all-time highs. I might also be going into some 30 to 45-day cycles, doing some in-the-money credit spreads, looking at probably, 60 cents on the dollar, hopefully 70 cents on the dollar, where if I took both sides of the trade, I still make net profit. I could also just take one side of the trade and just realize that let me open up another workspace. So let me check here. One thing that's pretty simple, let me throw in another moving average. I'll stick around. All right, man, that sounds good, Jay. Thanks. You stick around. I like it. Oops, not screener. There we go. So I want to look at something really simple, okay? We obviously have stretched pretty far. This is my 50-period moving average right here in blue, my 144 and my 200. Now, you can be really simple with this outlook and say, unless we have a price that suggests we are starting to show some type of bearishness to retest our 50, we've got to look at market breadth, and that's a pretty easy take. So if we go to finviz.com, take a look and see as of the heat map last week, it wasn't like everything was up last week, okay? You see the advanced decline section right here, 52.5% advancing, 44.3% declining. You had some new highs last week versus new lows. This is where it's going to get really tricky with the broader market, okay? Now, it shows that a majority of the stocks are above 62.5% of stocks above the 200 moving average. Okay, fine. So we're clinging to an overall buy zone. But recently, we're watching this SMA 50. Okay, this is your simple moving average 50 period on a daily chart, and it's at 50.7 to 49.3. So there's a lot of stocks right on the cusp, and we're about to roll into Q2 earnings with financials kicking off this week on Friday. You have a lot of stocks are on the cusp of weaker earnings, okay, or softer earnings, and all of a sudden we start to see that the majority of our SMA 50 stocks are below the 50 period. That means we're in, again, the broader market might be sideways. The broader market might be flat. The broader market might start to sell off below the 50. And it's going to look something like this. If we get below the 50, let's take a stock. Well, there's a lot of stocks we can choose from, but let's choose a big tech stock, or at least a tech outlook stock like ARK. Okay. You can see how everything is consolidated. Okay. So is ARK able to do something? And again, this is 3 to 5 years out. This is disruptive tech. Are we going to see this get healthily above the $46 to $47 zone? Can we break above here and look better? If we let's look at Nike. Okay, Nike just had a big drop all the way down to 75. You can see here that the 50, the 144, the 200 stock price is below all of that. So my point is this: if we look at the SPY, okay, This is the floor that I'm watching really carefully. Now, price action is going to be my kind of ultimate indicator here, not just a bunch of moving averages that are based in price anyway. But because we had that rip last week, Friday, Wednesday, and Tuesday, right now my floor on the SPY that the bulls would be defending, okay, and the bears would be trying to break. That floor is 542.30. Okay, so let me put in, let's put in a line right here, horizontal ray, right there over my chart alarm. And let's see if we can go, well, I guess I'll just leave it there. I was just going to try to edit the line if I could. All right, well, it's fine. So 542.30 right here. If the bulls are going to defend a pullback zone, that would be my pullback zone. If the bears are going after some type of structural break, it would be a close below that level there. Now, where does that open up the potential correction zone? Previous highs. You know, we're talking about a 3 to 4% correction if we come back into that previous resistance. So let's check. And again, this is not me calling the top, okay? That would be a 5+% correction. Things would get a little hairy, a little scary for sure. And how quickly and how violent does it happen? I don't know. Does it happen at all? I don't know. Right? But do we have some news this week kind of rattle it up? Sure. Powell testifying, CPI and PPI. The market's expecting a rate cut coming in September. Possibly Powell this week with his, much anticipated comments, whatever he's going to say. He's been quite the wordsmith on saying we could raise rates, we could cut rates. It's going to be data dependent. The guy keeps talking about that stuff, right? So the Fed Watch tool, however, is changing, and Fed Watch tool. And right now the probability reached 70%. Now, what I like about this tool is it's right. Every time we come into an FOMC meeting, it is right. Now, it doesn't mean that it can't change, but we have inflation data this week for the U.S. The rate decision for the Fed is not going to be till the end of the month. If there's some surprise, which there probably won't be, here's a 95.3% probability that the Fed does absolutely nothing for July. Skip ahead. There is no August FOMC. It's going to be Jackson Hole. Then you come into September. This is when the rate cut is expected. This has been inching up for the last month or so from around 50-50 to now 75.4% expecting a cut in September. A couple other stats I wanted to show this morning, just on the bigger picture. Okay, CPI seen rising 3.1% annually, the lowest in 5 months. Now, I look at this chart, and if you think about where we peaked back in, this looks like I think June would have been June of 2022, where we had like a 9.1% read on CPI, and we've peaked and we've steadily headed lower. But I look at that red bar right there. I'm not super excited about inflation getting below 3%. It has been sticky since 2023 summer. We have oil going higher. Certainly, your core inflation, which excludes food and energy, that's always the big debate is, okay, the Fed's numbers, the data excludes the things that we pay for the most, the things that are most, obvious to us as far as just staying expensive, rising in prices, affordability on houses are the worst they've probably ever been or have been, based on what it takes for a median household income to afford a house at these current rates at 6.95 or 7% essentially. So inflation data will be important this week. 3.1% is the expected move, right, for Thursday's print. 3.1 year over year expected. The market could get pretty excited if we printed 3% or 2.9. If we could crack that 3% barrier year over year for the first time in a while, that would be probably exciting. I wouldn't be surprised if we see something higher. I would be quickly watching for some follow through in the market to maybe throw out a bit of a panic. Just saying, if inflation data isn't coming down, guess what that means all of a sudden? It means that this probability of a cut is not going to look as good if inflation data is proving to be stickier, right? So just a couple things we have to be mindful of. I think that's important to watch this week. Look, I know it's July. I know it's typically low volume. It's summer trading, path of least resistance. I totally get it. But there's enough news this week to pay attention. Now, I do have some positions to the downside as kind of some hedges. I'm looking to certainly follow up on probably protecting, 25+% of the portfolio, 50+% of the portfolio. Hedging is going to cost money. I've talked about this extensively over the weekend with a couple of other trader friends of mine. And look, if you're going to hedge a portfolio, it may cost you that like you would insurance, right? You pay for it, you hate it until you need it. And so, you're thankful that look, if it costs me a couple $1,000 to insure, several $100,000 in my portfolio, great. But the payoff has to be worth it. I need to make sure that my, insurance in a way is going to cover $50,000, $100,000 in potential snaps. If I have a drawdown on my portfolio of 5% or 10%, I need to make sure that I'm at least mitigating some of that risk. So ways I'll be doing that, I'll talk about that more in my trading rooms this morning. But probably going out of the money, probably buying some 5% out of the money, 10% out of the money, maybe go out 60 to 90 days. I think right now, if I can look at least through September, I'm going to revisit pricing on the VIX through September. I'm going to revisit maybe some E-mini futures on the S&P as well as the SPY, and just buy some inexpensive puts, have it not cost me a ton, but have the payout be ridiculous. And if we do have an aggressive sell-off in any way, shape, or form, let me go here. If we do have a sell-off, we do break that floor, great. It would be a big spike in volatility. We've been looking at, if you're a Tasty trader out there, Tasty Trade has their IVX and IV rank. We've seen, single digits on the indexes this year, and we've seen it, kind of rally back into the teens a little bit. But the overall volatility is low. The VIX is sitting around 12 and change. So we're at 1259. We really haven't had anything exciting in the VIX happen since this May spike to the upside, which was interesting because that was not the correction, right? So this was the correction in April of this year, and that completely took out these recent lows, and we had a little bit of an uptick in May, but that was coming around earnings and some drama with the Fed once again. And here we are back at 1259. So, I'm long a VIX August call at 1050, and I'm looking to see if we can have a spike up back towards 1516, possibly revisit to 1920. We'll find out. This week could be something that kind of puts a dent in this path forward. But what we might experience, and again, this is the hard part, is we've experienced so much volatility, so much direction the last 5 years of trading. There really hasn't been a sideways period. The last time we were sideways would have been 2015, 2016. That's the last time we were sideways. This market has pretty much been ripping and trending one way or the other, mostly bullish, obviously, because we're at all-time highs. But outside of a 2020, 2-month correction, and nasty, of course, and then 2022, we had a pretty steady decline from late 2021 into really 3/4 of 2022 until we had that November rip. And then 2023 was a big recovery led by Mag 7. 2024, the market took on a whole new identity with AI taking large cap, using this market cap weighted instrument like we have here with the SPY and the Qs reaching all-time highs and way outperforming the other indexes, right? SPY and Qs double digits, 17 to 24% respectively. The Dow's up 4%, the Russell's up 1%. It's a big, big discrepancy between what indexes are performing well. So the argument this year has been it's not a bull market. It's not a broad bull market. It is a narrow, it is a highly concentrated bull market. And that's what makes things a little concerning, right? Doesn't mean it can't go longer. Doesn't mean it can't stay overstretched. I read an interesting piece this weekend. Volatility as an instrument is a mean reverting tool, but stocks and indexes don't necessarily have to be. A big discussion this year has been large cap outperforming small cap or tech outperforming value. Okay. Doesn't mean they have to revert. It means there's opportunity. Value is certainly a great price right now for the most part versus growth. Your Russell. If we saw a rip in the Russell, IWM, your 2000 stocks right here. I mean, for 202, we're up a little bit pre-market on Russell, which is nice. If we get back to, let me go to the weekly chart here. If we get back to highs, I, for one, would like to see if we can rip from 200 to these all-time highs at 240, the potential outperformance for a small cap at 20% as an index. I mean, right now, could you imagine that we have another 20% left in the SPY? That'd be pushing up towards 40%. If we have another 20% the Qs, that's over 45% for the year. Those are monster numbers. So I do wonder, probability of rate cuts looking higher. Powell this week, maybe hinting. Maybe he gives it away. Maybe he lets the markets price it in. Probably not. This is what he's so good at. Everyone gets excited. Powell's going to be testifying. There's going to be some headlines coming out of his speeches or comments or whatever, what have you. But the data is really going to hit on Thursday and Friday. So I'm not necessarily looking for, price to have to make a decision this week. But if I went out 20 to 30 days on some of my option trades, I do think that price is going to have to make some type of directional decision. And whether we can sustain these highs, and I apologize that this is a little noisy on my chart, but I've obviously posted some comments as we talk through these live sessions. I mentioned this last week in one of my live sessions, right? Hedging is not free. It helps alleviate the pain in the drawdown from sell-off. It can assist and certainly help in a black swan event, but it costs money in some way, shape, or form. There are a couple of hedges that I take where, if you're trading currencies, you can trade currencies in the FX market to, hedge and also have, offsetting gains. So if my portfolio in stocks, options, futures is in a drawdown, currencies, perhaps futures is a great hedge as well. But those are mostly seen for, maybe I hedge for the quarter, maybe I hedge for the month. You can do short-term trading as well. If I'm following price action this week and we start to see some dents. Okay, let me go back to this chart here. This is in the background, my weekly candle. So the shaded green is my weekly candle. Inside of this, I have an opening bell range from 9:30 to 10:30 to see if the market's going to break out and go somewhere. This week's trading, we're going to find out. Do we break last week's high right away? If we do, probability is we stay here, even if we go sideways for the week, but we would not break the lows. This is SPX. Okay, so my floor for the SPX is 54.44, and my floor for the SPY, as I mentioned earlier, was 542.30. Just setting chart alarms. Okay, it's technically more like 542.50. I'll put that in here in text. So 542.50 bearish. Well, I'll put floor. If that floor breaks, we'll see how strong the break is. Okay. But pre-market, we're already up about 80 cents, which means we open up and we crack the highs from last week. You got to wonder if that move gets faded in any way, shape, or form. Levels to watch for, we're opening up in about 5 minutes here. I don't see much to the downside. I mean, my gamma levels to the upside still remain printed, elevated. I don't see huge contract sizes here, but 560 could be a nice target. That'd be around 5,600 on the SPX. So just looking to see if this melt up continues. Okay, but if we put in a healthy top this week, what is a 560 to 540 correction, by the way? Percentage-wise, 560 to 540, you're looking at about a 3% correction. We have not had, by the way, we have not had a 2% correction day in over 377 trading days. That's a long time, but that's not historical, okay? We've had stretches over 1,000+ days where we have not seen a 2+% single day. But doesn't mean we can't have that in a week. As we saw in April, market corrected 6 to 8%. It took a couple of weeks, but as I keep mentioning here, you got to watch price. If price is going to stay up and elevated, let me get rid of some of the stuff here. There we go. Okay. So if price stays elevated, price stays sideways, I just got to watch the floors, right? I'm way more concerned if a couple things happen. If we break below 542.50 and we start to look like that 50-period moving average could come into play. Let's go back to the SPY here. Could the 50 moving average come back into play? Sure. Right. What did the market do from this rip? We got here above the 50 period in November. We stayed in this really ridiculously healthy and aggressive bull market. What did the market do in April? Pulled back to the 50, closed back above. It doesn't have to be that complicated. You can look at price, watch your price levels, watch your simple indicators and moving averages. If we're going to show that price is red, let's say, bearish engulfing, let's say whatever, dark cloud, let's say something ominous on a daily, weekly chart. Let's say that the month of July, it looks like it closes, with a big red candle. Okay, fine. If there's follow through to that, I would just look and see what the daily moving averages look like. We pull back to the 50, great. If we go below the 50, back above the 50, that's resumption of the trend. We go below the 50, stay below the 50. Now that brings in our 144 and 200 moving averages for potential landing zones. Okay, just depends on how violent this gets. If a lot of the optimism, the rate cuts are all being priced in, this is that classic buy the rumor, sell the news situation where, look, the Fed can cut in September. We might signal a top in the market. I've said this for the last couple of months, especially if we see a rough October to December this year, election as well. I mean, election is going to be drama. There's going to be a lot of volatility and uncertainty around the election. But if we have a rough Q4 and this market can't finish higher in Q4, that does make me really concerned going into 2025. Now, if we ignore a lot of things, we just rip, and all of a sudden we're talking S&P at 6,000, SPY at 600. I've looked at that level. I think it's realistic that we could see this melt up rip to those levels. All it is just a big channel, and I think on this chart right here, there it is. So 600 is not out of the question. I think a pullback would be nice just to kind of reestablish some buying opportunities and see how hungry these bulls are to keep chewing away at the markets. But man, 600, it's there, but at the same time, so is 500, so is 460. So we're just above the halfway point of this larger channel, and this goes back to a couple of highs from 2018. So it's not nothing, right? You're talking about 6 years of technicals, pretty wide because we've had some booms and busts the last 5 to 6 years, but the market keeps doing its thing. So it's hard to call a top. I'm not trying to call a top. I'm just being realistic to say if certain price indicators or certain price levels are broken, I'm paying attention. Okay. I'm not blindly bullish. We do have a positive drift environment on this instrument anyway, but if we go sideways, we got to be ready for that. If the market struggles to, just rip to all-time highs again and again and again, we got to be ready for that. Okay. I think hedging to the downside is going to be important to be willing to pay some insurance. Okay. A little bit of insurance just to make sure that, we're not caught off guard by some, 5 to 7 to 8 to 10% correction that we don't see happening, or we think it's going to happen. It's just the markets move faster. These rotations are faster. These cycles are faster, right? So I don't want to be caught flat-footed or off guard as you wouldn't want to be. Okay. All right. Let's take a look at some charts. Initial question came in on gold, Pulver report, kind of report. We'll go dollar index, oil, gold, silver. Take a look at some currencies. Here's the weekly chart on the dollar. Okay, why do I think the dollar's been weakening quite a bit? Well, it looks like the probabilities have shifted in a big way that the market's expecting a cut from the Fed. Now, look, the Fed can cut, okay? The Fed can cut, but other central banks are doing the same thing. So I think that you have to take every dollar pair in Forex the same way. You got to look at each individual pair because they're not all the same. This last 4, 5, 6 days of selling still has not broken any major support. Now it looks like we're no longer nearly as bullish. I mean, I was pretty adamant about this 105.60 level. We ripped up here from the 104s. And I thought, okay, well, if we, pause at 105.60, we hold that level where it was a breakout point. Now we're holding support and we continue to inch higher. It's not happening right now, right? So I still think the dollar is a tough index to read. I'm looking for some indecision here as opposed to full-on direction. Okay, we have not seen a lot of clarity out of the dollar since we had indecision here and some pretty good structure in here. So, 105.60 continues to be some resistance. 103.90 continues to be some support. take each individual dollar pair as it is. I think Aussie dollar's been performing pretty well to the upside. We just got a breakout on that last week. So there's our breakout on the Aussie dollar above that 6,700. If you look for a pullback, this would be a pretty straightforward trade. Look for a pullback, see if this resistance holds as support. Look for it on a smaller time frame. 1 hour trends, 50-minute trends, 5-minute bounces. Looking for 67, right around 6,700, 6,710 to offer some support and see if this Aussie dollar continues to rip higher. Euro dollar, the ECB has cut rates. Okay, I have a position on the euro dollar that's not looking great. I'm probably going to get stopped out right above that CPI high from this summer. Let me see. Is this a little bit better on the table? All right, a little bit better here. All right, so this was our June high, and we're looking to come after that. Again, pretty noisy. I don't feel like I have to just flip positions. Okay, and be like, oh, I got stopped out, I'm going to reverse. Well, maybe this just keeps making lower highs, but we're about to turn, right? If we end up doing something like this, we just pop up here, test that level, and then fade back down. We do have some indecision. And what I'd like to see is I'd like to determine, do we have some bigger move coming on the dollar crosses? And maybe we do. So as I'm talking through these dollar pairs, just take in individual setups kind of as is. Okay, pound has been looking great the last 4 or 5 days as the dollar's been selling off. But you can see here that if the pound struggles to get above that resistance meaningfully, or if we don't have a push and some type of flag, maybe there's a bull flag there. Well, if that's the case, fine. That's a tight stop loss. But what I don't want to do is, buy into this rip for 4 or 5 days, put a stop loss down here, and then watch this thing come right back down. So if I'm taking trades, I'm essentially going to look for bull flags, bear flags. Can we see the market go somewhere with a relatively tight stop loss just to make sure that my reward is going to outpace my risk? Okay. All right. New Zealand dollar. New Zealand dollar. Well, the Kiwi has a rate decision this week. They may hold at 5.5%. We have a 60.90 sell that's upside down. Our stop loss is at 61.65 or 61.42. So we have a little bit of breathing room, but not much. I wouldn't be surprised if some of the noises get stopped out. The dollar has sold off. The dollar CAD is also vulnerable. I have a stop loss down here at 34.70. I'm looking to see if this floor around 3,600 holds. If it doesn't hold, if this floor doesn't hold, there's my stop loss. I was looking to see if this structure would hang in there. If the dollar CAD can hold 30, what was that floor? Around 3,600? Yeah, if the dollar CAD holds support at 3,600, we have some decent support from 36 to 37 and change, 36 to 37.50. I was still looking to see if the dollar CAD could get up towards 39 or 1.40. We'll find out. Okay, dollar Swiss, I'm still long, and this one can drop, and I'm actually kind of happy to see it dropping. But this one to me is a nice head and shoulders pattern with a big carry trade opportunity. And of course, everyone's favorite, the yen. We've pulled back a little bit on the dollar yen from 162 back to around 160.67. Last thing I'm going to do is call top on the yen. Yen pairs for me, if you're going to be a seller, there's your inner to outer trend line. We are watching rate of change on the yen crosses to make sure that if we see a depreciation on the yen by 10, 11, 12% over a fairly short period, that there might be another level of intervention, but we don't know what level that's going to be. Okay. I'd mentioned that from this recent intervention we saw from April, this would be a potential BOJ intervention area. That'd be about that 9 to 12% move. So 165, 170. I've told traders all year, either one, don't trade the yen, or two, only focus on buying against the yen in the short term. Get your alignments on a 1 hour chart, 15 minute, 30 minute, 5 minute, 1 minute. I don't care. But if you look at buying against the yen, that's been a pretty simple trade all year. The hardest trade has been selling with the Bank of Japan intervention on your side, which is insane. Never in my career, Forex trading wise, did I think the only way I can make money on this yen if I wanted to be a seller is by having a central bank on my side. That's the last thing I would trust. So Again, if we're going to break down, there's still a long ways to go for the dollar yen to actually show confirmation to break. So I don't think it's happening. We still have plenty of upside potential. We have plenty of support. The BOJ policy doesn't seem to be changing. Their Nikkei 225 is trying to reach highs all over again from the peak we saw back in April and May. So right here, right, we had a peak back in March. We had a correction, and this is right back up to the tops again. But again, is this top heavy? Highs right here, highs right here. That could also be a pretty scary thing. We either range where sideways is okay, but what would be a little alarming would be, let's say we don't break the tops. Let's say we come all the way back down here. Well, expect some yen strength and we see a sell-off on Nikkei. We saw some intervention in here, so it's hard to see the correlation between, oh yeah, the Japanese yen got stronger. It really didn't. We just had intervention. Okay, but we could also blow these highs off, and then Nikkei's up the new highs. Guess what that means for the Japanese yen? Weaker, probably weaker. Please elaborate why we shouldn't trade the yen, because I hate it. No, I mean, in all seriousness, the reason I don't like to trade the yen is because you're trading a currency that doesn't really behave technically. Okay, now and it does, right? But when we have periods like this where it's a carry trade, it's a risk on, risk off trade. It's driven by central bank policy, and it's influenced and manipulated and intervened in. That's no longer trading the kind of the purity and the technical efficiency of a forex market. The reason I love forex is because you can trade patterns and pockets and pivots and efficiencies, and not have something just be fundamentally driven. So because the carry trade is alive and well, I think the best direction would be just to be long against the yen until everything on your alignments change. Because right now, if it's up on a weekly and up on a daily, every yen pair has been weak, right? Everything against the yen has been strong. It's just something that we shouldn't be fighting. So, and I say that because I hear a lot of traders that will comment, I'm in this trade. When's the yen going to get stronger? That is not the question you should be asking. The question you should be asking is, how much more can I profit from this weak yen? Because that's what you see on the chart. Everybody can see that the yen is weak, and it seems to be a trade that's alive and well. So until the obvious technicals are aligned to sell the yen, I think the best rule of thumb is, one, don't trade it. Look, I'm a position trader. I don't like to jump in and scalp and day trade. That's essentially what I'd be doing on like a 1 hour, 4 hour, 30-minute time frame, is just consistently trying to go in, trying to grab some small positions out of the yen cross, get some buy trades. Okay, that's an easy strategy. Doesn't mean I'm going to be right all the time, but if I can let my winners run, we've seen that the yen continues to make, fresh highs. Dollar yen's making fresh highs, Aussie yen making fresh highs, CAD yen, Euro yen, pound yen. Even since the April intervention, we've been pushing up to those levels. So point is, I don't want to see any trader out there getting stuck in a yen cross, because it is going to take way longer than you expect, and it's going to be way more painful than you expect. And that's why I say, don't trade the yen. It's not worth fighting it. It's not worth being frustrated by it. If you don't understand what the yen is doing or how the yen is behaving, then don't trade it. Trade other currencies, trade other technicals, stick to the efficiencies that make Forex so great, right? That's why. So there you go. All right. Oil, gold, silver. Oil. 82.33, a bit of a pullback. I still think we're bullish here. I've got stop losses below the swing at 72.50. Even a pullback on oil, pretty well supported at between 80 and 77.50. So even a pullback, I'd be looking to kind of buy some dips on that. I want to take a quick look at copper. I might actually look at some copper futures this morning. You got to be freaking kidding me, dude. Shoot. Well, that was a nice little 618 pullback. I was looking to see if I could get long copper. I missed that by a couple of days. Man, that's freaking last week. All right. Well, I'm going to see if copper will settle back in. Maybe I can establish some long positions, maybe get futures long here around 4.33. I'll take a look at that this morning in the trading room. Oil, gold, silver. Gold. I had a nice rip last week. We had some recent levels at 23.94. I'm still bullish on silver and gold both. I like silver better technically. If we get up towards 24.40, 24.50, I'm watching gold closely. I have some GLD positions in. I'm long. I bought it back here on the equal lows. This 22.83 was the equivalent to around 212 on GLD. and I'm watching these levels closely. So I think on my GLD position, I have a covered call in at 232.50, which is up to some fresh highs. So watching that carefully. Silver's had a nice rip. This was something I've been watching closely, trying to break this high around $30, and it's roughly $31. Silver made a nice run above $31. I'm still looking for silver to go at least towards 35 and change. Hopefully that is still coming. That's a measured move. That's a symmetry move. Again, we might go sideways, but I think silver is postured pretty solid. After getting the trendline support, silver's moved up nicely and breaking this recent high as well. Hopefully we will stay here for some type of bull flag, and then silver looks good to the upside. The only issue that I have on silver is I have silver futures long. That's fine. That's helping. But SLV, I've got a bunch of puts out here that I'm trying to take some ownership towards the July 19th expiration. I was willing to take a lot of shares on SLV. And it looks like right now, since we had this dip, we were down towards 26, and I was like, okay, I'll probably take a couple hundred shares. Now, if we keep ripping to the upside, there will be zero assignment. But it'll still make me a couple $1,000s and having zero assignment, which I'm okay with. But I was fine owning SLV for a run up here towards a measure move around 32.80 or higher. I'm still going to try to get some ownership. Maybe I do. Maybe we stay below $29 and I can still get assigned somewhere, and I'm okay with that. And then the rest will just be credit. So that is oil, gold, silver. If anybody's been paying attention to crypto, not looking great. And again, you can go back for the last probably month and watch into my sessions. I talked about a potential bull, a bear trap rather, right? So we have resistance here. We have support here. These bulls better step the heck up right now. We're coming back into this pocket, finding some efficiencies. If we're going to step up, this is a pretty good time to do it. So this, to me, you notice how we tested and tested this low. If this is a bear trap, those bulls better step up and get this thing back above 60K. If they don't, and we stay on the left-hand side of this trend line where this continues to sell off, this does not look good, right? That price action does not look great if we continue to sell off. If we hold where we are, get above 60K, I think we stabilize the sell-off, possibly make another justified run back up to the highs at 73. But got to watch price, because right now, bears have had some momentum. The bulls have pushed but been faded each time. So I'd say above 60K, that's where there's a bit of a sigh of relief that the bulls can still maintain control and show they're interested in taking this higher. Ethereum, 30.26, same type of thing. I got filled on a pullback here, I believe, 29. I'll have to double check my fill, but I think I did like a 3,000 or 29.50 futures contract on Ethereum. I did a micro Ethereum. So I'll see. But again, is this support going to hold? I'd like to see Ethereum get back above probably 32 to 3,300 for those bulls to step back in and show that they want to hold these lows. So if we hold support, maybe range bound, Bitcoin, Ethereum heading back towards these highs. Ethereum all-time highs is 4,800 plus. We haven't hit all-time highs yet. And this has been a combination of things. We have, I know Mt. Gox has been a big story the last couple of weeks. Just a major dump of supply coming into the markets, which has been leading to price. There's been some risk-off trading as well. But anyway, we'll watch and see how this stabilizes. Okay, uranium, sure. Uranium, so we're sideways on this. I have a couple of interesting plays. I have some credit spreads on uranium. I have some leaps on uranium. I also have some jade lizards on uranium, where I have a naked put and a bear call spread, just to try to keep it. It's fairly sideways right now. So that's what I'm trading. My puts are down here at 22 and 23. My calls are up here into the mid 30s. And so far that's proven to be, credit upon credit, which has been pretty good. But longer term, I'm looking at uranium out towards the measured moves, bullish on this towards 41 and change, bullish on this towards a fifth wave move to $55. There's not a lot of stocks that I can find out there, or instruments rather, that, 40% to potentially, 80+% to the upside. So I still like it. Pullback is fine. I want to have some protection if I'm long, but not a ton. I mean, I should say like not super expensive insurance. Out of the money, 60 days at a time, dirt cheap. If it pays, it pays. 10 to 1, 20 to 1. If it doesn't, it's just going to be a little offsetting off my bottom line. But it's volatile. So hopefully this sideways movement is just kind of rebuilding a base where the bulls can take this thing back up. There is, I know there's some developments out there with, nuclear energy, nuclear power making its way back into the fray in a big way. I didn't mean to rhyme all that, but basically, nuclear energy was so concerning because it's built in old technology, and now there's new ways to make cleaner energy, and nuclear energy could be a big push into the future. Uranium is going to be a big part of that. So, I know we've already had some supply issues on this, which is why I'm long uranium. There's been some interesting discussions out there with, who's following and how bullish people are getting. And I know a couple of funds out there that are like probably to a ridiculous amount long uranium and long, kind of energy and inflation and stuff like that. But we never know. We'll see how it plays out. Okay. All right. Let me check a couple of things here. All right. A couple more. Let's go semiconductors, SMH. Trading at 274. The NASDAQ did make all-time highs. Semiconductors made a big comeback here, but they didn't eclipse the highs. So again, not something I want to fight. We did have a pullback into the teens, right? That was a 8%, 8 to 9% correction on SMH. But NVIDIA, which is a majority of that just based on a market cap, we had a pretty big correction on NVIDIA, around 15 to 16%. NVIDIA nowhere close to the highs. You look at your MAG 7 or whatever you're calling it now, Fab 3, Fab 4, AI, hype, blah, blah, blah. Apple, has had an incredible comeback. I mean, I'm happy I got long Apple at 170. That's been proving to work out pretty well. The only problem is I covered it at 200. So it's going to get called away. I'm trying to do some rolls on this without having it. I don't want to pay debits, obviously, to roll my covered calls. So I'm trying to just let it marinate, but I'm likely going to get called away for probably $30 a share, something like that. But I'll keep rolling it if I go out a little bit further in time. I'm trying not to roll it out too much further than December of this year because I don't know what, of course, 2025 looks like. We could have a big look, if we're at all-time highs, if we're at 600 plus on the SPY or 6,000 plus in the S&P, I'm going into 2025 with a bit more of a bearish tilt, but that's just me. So Apple, all-time highs. Microsoft, all-time highs. Seems to be doing no wrong. Google, ripping to all-time highs. Meta had a big rip last week as well. Kind of a bit of a catch-up trade. Meta back up towards 533. So anyway, a lot of stuff to watch. Take a look at the short-term movement here. We'll wrap up in the next couple of minutes. 556. So we opened up above last week's high. So a couple of things probability-wise that we're not going to break this week's floor. That's about a 88% probability that we will not break 542 for the week. If we do, that's already a $14 move. Okay. The question that I have is, can I actually get positioned on that to make some money? Let me find out. Let me go into my Tasty platform. Okay, Jay, I appreciate that. Thanks for the comments. Really quickly before we wrap up here in the next few minutes, if you're watching this live on YouTube, do me a favor. If you're not a subscriber to the channel, go ahead and click that subscribe button, click the notification bell. So when we go live, you know when. You can watch the video live, of course. You can watch it archived on the YouTube channel. That is youtube.com/Chris Pulver. If you're watching on LinkedIn or watching on Facebook or watching on X, it's fine too. Just appreciate the likes and subscribes out there on all the media platforms. It certainly helps. And where's my Tasty trade? Also, if I have some traders out there that are following me that would like to join me on my Discord channel, everyone is welcome. I did add some things to Discord this weekend. So this is our free group chat, which is where I like to keep most of the conversation. But I wanted to go ahead and just up some additional subject chats where if you're a Forex trader and all you want to hear about is Forex or talk Forex, we can post it in the Forex chat. You want to talk stocks, there's stocks. You want to talk options, there's options. You want to talk futures, there's futures. So, have the group community, just talk anything and everything. Obviously, keep it trader centric. But then go into your favorite assets and talk about it there. Anytime I'm live on YouTube, it's right there. My weekly blog, anything I post on Twitter, any analysis I think is interesting, any education I have out there, from courses to robots to trading rooms, all available under one spot. I do a lot of private instruction on the weekends and evenings. So if you're interested, you can contact me in private instruction. And then affiliate links, I've got Edge Finder with A1 Trading. I've got Edge Full. I've got Dynamic Trends. I got Tasty Trade. I've got 8cap. I've got plenty of affiliates out there that if you are looking for a broker, I try to have good, again, I'm not pushing anybody anywhere outside of, I've been in this market for a long time. I've been in these markets for a long time. I work with really good people in the industry. I think it's important that as a trader, trading is hard enough. Don't let your broker beat you up and bully you, right? It's like, find a good broker, know your money's safe, focus on the process, trade, and software research tools, stuff like that as well. So if you have any questions on that, feel free to let me know. One thing I will say, just as a quick disclaimer, I don't send direct messages. Okay. I'd say the best thing to do is if you're joining my Discord channel, just come in the free group chat. This is where you can find me. This is me every single day, real Chris Pulver. You will find some imitators, you'll find some scammers, and it probably comes in the form of direct messages. If you join my channel and you get a direct message, it's not me. I promise you, it's not me. All right. So I like it when people join. I can see right here. I'm just going to say welcome right here in the free group chat. So that's the best place to find me. Okay. All right. I'll post the Discord right now. Yep. So let me go into, I don't want to edit the channel. I just want to post an invite. There we go. So let's go. This link will not expire. And there's my link. And here's my Discord. There you go. So if you want to pop in and join, awesome. Like I said, free group chat. This is for everybody. You want to go to a certain asset class specifically, check those out. I just added those in. And again, this is the best place to find me live every single day. I do not send direct messages. Okay. If you send one to me and it's actually me, I'll obviously reply. But I try to keep all of it right here in the free group chat for everybody. Okay. All right. So here we are, 5:56. I was looking for my Tasty platform. Here's going to get logged in. Okay. I want to check on a couple of things. And I'm pretty sure from what I'm seeing here that I'm not with the A1 trading team at 10 this morning. I'll probably do that later in the week. So we'll go a little bit longer. I want to take a look at some trades. Where's my Tasty platform? It's coming in. All right. I can get rid of that charts. I get rid of the watch tool. Red and green shades up here. How often do you do? So typically I'm live on Mondays and Fridays. I'm live for this type of Pulver report on Mondays and Fridays. And usually Monday through Friday, I join the A1 trading team, Trader Nick out there and his team, Frank and James, the whole team at A1 trading, Drew. We have a lot Eastern time if I'm available. I offer it up where I can jump into their sessions and help collab. So like I said, if you're in the Discord, easy way to find it is it pops up here. So that'll be the actual link. So anytime I'm live on my channel, you can see it pops up there. So I think with some of the marketing and branding with A1 Trading, they do. my stuff is pretty simple. All right, let's go to Tasty. So I think it's important that I do some hedging. I'm going to read. Some in and out. All right. I think I'm getting a little bit of a kind of a clog here in the band and stream with the Tasty platform. So let me do this. Let me just minimize some of this stuff. We're good there. Get rid of this browser. Okay. Is it sound better? Give me a quick AV check. Let me just type in something in the chat for me. If you hear any sound in the background that sounds like snoring, that's Benji. Okay, we're good. All right. So a couple of things. I'm long on oil. This is a futures contract. I'm long. Actually, it's basically a credit. It's a credit hedge that I put on the ES. That's a futures contract for the S&P. I'm long gold. I'm long the Russell. Out of the money, out of the way. Long silver. A couple different contracts. Apple, I own the shares, and I'm also long on Leaps. Amazon, lots of trades on Amazon. And looking for, where's my P&L positions? That can't be right. It's the cost. Okay, I was like, there's no way that, okay, I'm looking for my P&L on Amazon. Cap requirement. Let me check an individual account here. I might reorganize this summary. So anyway, I'm just going to give you the overall, directions. So I like Amazon a lot. I've had some exposure in China. It has been okay. I had some really good profits in March and April, but they have really given back most of those gains. Alibaba's down, Baidu's down. I'm also in KWeb and FXI. It's mostly through options. I do have some shares of Baidu right now. The stock is trading at 88. I have it collared, so there's protection to the downside below 85. If I get it called away, it's up to 105 or better. I'm still in some Bitcoin exposure with BITO. That's a Pro Shares. That's an ETF you can trade options around. I also have some IBIT, long on aluminum. Chewy, we've had some good money on Chewy this year. I know Roaring Kitty made a big post and it ripped up the $37. I'm long since like 17. I've lowered the cost basis on options, so that's actually made some pretty good profits. Costco, out of the money credit spreads. Cisco, out of the money credit spreads. The Dow, ratio spreads. FXI's exposure on China. FXY is the play on the Japanese yen. I'm early on this one. I know that I am. The yen keeps depreciating, but this is one way that I can stomach a drawdown without having it cost me an arm and a leg. So I'm looking at kind of dollar cost average in over certain rates of change on the FXY. GLD, I'm long. Google, I am long with some out of the money credit spreads. IWM, I'm long, trying to stay. I'm enjoying sideways movement, collecting some premium on the moves right now for the Russell. JetBlue, long over on that one, just hoping we get. I don't know. It's an airline stock. It's cyclical, but people are traveling, which is nice. People stop buying the kind of discretionary goods, but they're still spending on travel, leisure, tourism, cruises, things like that. JD, that's a China play. I still like that one overall. I don't know. China's a different cat. It's a different trade. It's a different government. Obviously, like they're not fueling their rally and recovery with debt like we are. So you got to wonder if there's a power play at hand here with whatever happens with our election drama. Is China gonna have some type of geopolitical event with us? Who knows? KWeb, that's another China play. Meta, have a couple of way out of the money bear call spreads on that one. MO, this is one of my dividend plays this year. It's up a ton of money. I bought this thing, sub 40. I get a dividend every quarter for about 95 cents. And we're up about $6 on the shares in addition to the dividend every quarter, which is not too bad. Netflix, long on that one, out of the way. Nike put some trades on after we had a big earnings flop. I'm long essentially $60. I'm going to see if Nike kind of stabilizes. Nvidia, ratio spreads out of the money. Nvidia could drop by 20-30% before I take any ownership. This is a trade on, what is this one? Out of the money credit spread on Palo Alto. Pfizer, got a leap calendar spread on that one. Palantir, ratio spread. I saw this one ripped up to the upside. Probably not going to take any, but additional credits collected. PayPal, I've got a, what is it? Ratio spread on this one for right now. The Qs, ratio spread, silver long, SMCI, that's semiconductor play with NVIDIA, out of the money credit spreads, SPX and SPY, both directions on a lot of the indexes. AT&T, I'm long. TLT is the 20-year bond. I'm long on that one out to 2026. I think we have some type of event where bonds rally. The Fed starts cutting rates. We start dipping into the yields. Where the yields drop, the bonds rally. Hopefully the 20 years is a beneficiary of that. Tesla, overall, I'm long, and there's probably zero chance of any assignment. The problem is I didn't really get heavy enough in Tesla to enjoy that 40% rip we've seen on the last couple of weeks. Under Armour, I still own some shares of that around $6. Uranium, like I said, some option plays, just collecting some premium, but I'm long overall. Volatility is a bit of a hedge. Walgreens, it sucks. I'm essentially long around $15. I'm upside down. I'm trying to bracket. I'm trying to protect. I'm trying to, essentially repair the trade. It's a dividend play. I can collect a nice little 25 cents a quarter on 1,000 shares. It pays for dirt cheap stock. It's not bad at like 6 to 7%. Problem is it's a real turd right now. XLU, this is utility sector, and I'm looking at some 66 and 65 puts. And then YUMC, that's essentially YUMC is Yum Brands China. And I might take some assignment, I might not. I've got some profits overall with the other spreads. I did a bunch of leaps on that one essentially, but premium leaps. All right, so that's a little glance at the portfolio. It's time to look at some hedging. I will probably look at something in, let me go ES and see what it's going to cost me. So if I go out to trade, I'd like to go out through the end of September if possible. So if we look out to, I could go 84 days out into September. That might be a little expensive, but we're going to find out. Okay, and I'm going to look at a dirt cheap delta. So what would it cost me at, let's see here, at a 5, where's 48.50 on the chart if I did E-mini? So by the way, I'm going a little bit longer today because I can. If I'm not jumping into A1 trading, I'm going to go a little bit longer for this session. So let's do it, yeah? All right, let me go into ES. And let me find a price point that I'd be happy with. All right, so 48.50 is way the heck down here. 4,800 even lower. Now, the shift would be this. If I buy puts at 4,800, okay, or let's say 48.50 to 4,800. If I'm buying puts down here, it's not going to be expensive, but the odds of that trade getting in the money is slim to none. Okay, so I'm not buying it for the, this is going to be an in the money, an in the money put. What I would be buying it for is if I have, 2 contracts, 3 contracts, 5 contracts, the type of payout I could have on a long put could be enough to, finance any type of drawdown that I might have. So let me take a look and see what it's going to cost me. So this is a 4 delta. If I buy a put, okay, right now that put is going to cost me about $500. Okay, so if I did, oops, not there. I need to go contract. So if I just increase the quantity, it's going to cost me $1,000. All right, and I think out here to 84 days. What would that percentage be if we went to a 4,800? So that would be a drop in the teens. We drop about 15% if that was going to become at the money or in the money, which, again, probably not going to be the case. But for something that's going to cost me maybe 1%, there's a chance that it's cheap enough that the payout could be pretty lucrative. So let me try one thing here. If I go into a risk graph, try to build this real quick. Options chain, no. Let me go risk. Here we go. So I'm going to build this out on, let's go SPY. And I'm going to build out like a put spread on the SPY. So I'm just going to do a long put. Oops, not a short put. Long put. And I'm going to go out to September 30th and look at a 480. Come on. If I did a 480 put. Okay. So right here is current price on the dotted line. So we're at 555.76. This white dotted line is live price. Now, this is way out of the money. Okay. But in the event that I'm actually getting some directional movement, if we get down to, in the event that I said 542.40 or 542.50 is my breaking point, if we break below that, my hedge is going to start to pay off a little bit. The potential payout is ridiculous, right? What cost me $1 could pay, per contract could pay around $2,500. So for $100 risk per contract, potential payout of $2,500, that's pretty good, right? So let's say you've got about a 20-to-1 payout if you're spot on. Now, option price can be tricky because it's so far out of the money. I doubt it's going to be, but why would I take the trade? This is my black swan. If we have some ridiculous thing through August, September, if Jackson Hole is going to reveal some frailties in the market and the Fed doesn't raise rates in September for whatever reason, could this happen? Sure. Is it worth me putting in, 1 to 2% to pay out 20-to-1? Absolutely. So I think that's what I'm probably going to do is just have some hedges on here. They're not expensive. I would probably allocate 1% of this hedge to cover roughly, a 20-to-1 reward to risk. But again, if I pay for this, it's essentially going to be wasted money. If the hedge doesn't work and it doesn't pay me, then it is just insurance that is for the rainy day. So I'm paying for insurance while it's sunny outside, and I understand that, or I should say, it's a play. But I do think when we're sitting here at these highs and it seems a little stretched, and we have earnings season kicking off, if the markets don't give us just constant awesome earnings, I could see a sell-off ensue. I could see that, 540. This on the E-mini, 5,500 would be my floor right there. And so I do have about an 8% hedge on this one, but I'm just watching closely. So I think what I'm going to do is I want to see if I can get on this platform here. Can I do an E-mini? Four. So this is June delayed. Let me see if I can edit this spread. So it's not giving me my contracts. I think I'd have to go to September, which I don't know what letter that is. Let me try N4. Fudge. N4. Let me see, U maybe? Okay, here we go. This is good. So I have the S&P 2024 September contracts. This is delayed. I don't think I can't price this out. And then on Tasty, because I have so many accounts, I don't think I can get the risk curve on this, but let me find out. So if I did 4,800 and I look at a curve on this one, let's see if it'll show it. Yep. So it stacks up all these orders, which is annoying. So this isn't going to give me what I want. I'm going to have to see if I can take this bigger. Well, what I was looking for was to see, I'm going to go all the way down here to 4,800. So even this display is not correct because this should be, unlimited potential towards if the stock drops to zero. Anyway, that's not what I wanted. So either I hedge with futures and some leverage, or I hedge on the SPY with some leverage. Either way, one of them is going to get put in. It's either out of the money on the 4,800 level, 4,800 on the ES is all the way down here, 480 on the SPY is all the way down here. So do I think that those levels are realistic to get in the money? No, not at all. Okay. But if it's a 5 delta and we drop, let's say 5% or 10%, those deltas are going to increase. Okay. So it's possible I can still turn that hedge into profit. I'm also long the VIX. So one thing I might start with is going out through September on the VIX. Let me see what I can get there, and then I'll wrap it up. If you have any other questions, feel free to type them in. But I'm looking at a trade on the VIX through, I can only go out to September. It might be a little bit more expensive to go out to October. I want something at the end of September for that very typical September effect. So I might have to buy the extra time in October. I could do this on the VIX. I mean, I could do a $20 call right here. This wouldn't be terrible. I could hedge on the VIX at 20. And again, this is kind of an outlier event. If we did 20, it's going to cost me $166. The payout could be pretty monstrous. Let me see if I can get a dynamic trends risk curve in here. So let's go VIX and spread. All right, there we go. So I go out to October. If I buy the 20 call, there we go. So my fixed risk would be about $1.60, right? But ridiculous upside in the event that we have some big risk off or some type of widening credit spread, some type of risk off event, the VIX could pay out. So as a cheap hedge, what I'd have to watch for closely on the VIX would be this. I have a $14, $15, $16 alert. I've got a $20 alert. Even if I bought this thing, so what's an at the money right now? So if I bought this for $1.60, an at the money is roughly $5. So there's 3 to 1. So if I loaded up and put 1% in, I would have about a 3 to 4% hedge, which is fine. So a combination of out of the money SPY, out of the money ES, or out of the money VIX, probably allocating 1 to 2% to have a 10 to 20 out, 10 to 20 out. Okay. Let's see. Ball it's saying use Elliott waves or just concept in general. I mean, I use them. I think we're sitting on a lot of instruments. I think we're stretched into 5 waves. Looking, for example, here. I mean, if I start off of this 2022 correction, I mean, there's a couple ways I look at Elliott waves. It's either, we put in our COVID bottom. Is this 1, 2, 3? Maybe, and then 4 is coming, then 5 is still having to complete, or do we start in here after 2022 and have a kind of 1, 2, 3, 4, 5? And that's realistically what I've been after this year. This is why wave 5. I mean, look, wave 5 is great. Wave 3 is the best wave for profits. That was this wave 3. If I'm right on that, and the reason I don't just stand by Elliott wave all the time is it can be somewhat subjective. If I put my low here and somebody else puts it elsewhere, and you got lowercase letters and capital letters and Roman numerals, and it just seems like it could be a messy chart. So I don't pretend to be a savant in Elliott wave, but I can see some pretty simple wave structure in the market. So I could make a case that if this is 1, 2, 3, 4, we're in wave 5 or we're finishing wave 5. Okay. So if we get through this wave 5 stretch and we stay, kind of postured here for the summer, I could see again, maybe wave 5 finishes up here and then we have a 1, 2, 3. Okay. But if this is wave 5 that's just trying to finish, we have a 1, 2, 3, that could be a rough Q4. If we finish lower for the year, that could be this part of like, after a 5-wave move, 1, 2, 3, 4, 5, we typically see an ABC correction. Test this low or test that wave 4 low. And so that is what I'm kind of lining up on these charts. But I'm not calling the top. I just think it's crazy and stupid to call the top. So don't. All right. Anyway. All right. Let's do this. I think we're good for today. We've been going for about an hour and 15. Nice to be back. We got a full week of trading. Let's do this. Equities on Demand students. Let's jump in session today at 10:30 and have our live session. I'm going to jump into these hedges like we talked about. I think it's important that I have to spend some money for it. I'll probably spend 1 or 2% to have hedges out to September, October, trying to make it cost effective and just try to see what the potential reward to risk payout would be. VIX is pretty simple. If we have a VIX spike over the next couple of months, again, maybe it's August, maybe it's September, right? But I'm going out far enough right now that it's cheap enough. I could probably get a 3 to 4 to 1 payout. If I tied up, let's say $1,000, it pays out 3-4 grand. It's obviously a lot more money if you're doing it on the SPY, on the futures as well, the ES. That's going to be, to me, where the best hedge is going to be potentially, but it's going to cost more. So, all right, Equities on Demand students in the trading room. I'll see you in 12 minutes. Everyone that's been watching today, whether you're watching on YouTube, again, click the thumbs up button for me. I like that. Please support the channel. That's great. Like and subscribe. All the deal, right? And I know everybody says this in the videos, and it's like and subscribe, and it's like click the fancy bells. It's like that it does help. And so if you do like the content, and you think more traders can benefit from this, then it does help. And please do that. Cool. Okay. When will I be back? I will probably have another stream this week, multiple streams with A1 Trading. I'll be back for sure with this session on Friday at 9 a.m. We usually do Mondays and Fridays for the Pulver report, and then I sprinkle in the A1 Tradings through the week. So if you're on the Discord channel, keep an eye on this for the YouTube channel to pop up. Again, I added some chats this week. So NASDAQ and S&P 500, Charlie, we did that. I'm a little cautious on just blowing these markets up higher. We are going to see a little bit of a kickoff with Friday's earnings. We have a big news week this week. CPI, PPI, Fed, or Powell's talking twice this week. And then we have financials kicking off earnings on Friday. So I do think that, it's still summer. There's not a lot of disruption typically through July, but we come into Jackson Hole in August. We get into the September effect in September. I don't think the market's going to come to these all-time highs much longer. The question I'm asking is, how does the data come in this week? If the CPI data is 3.1, is the market excited? I would say the market to get more excited would probably have to be a sub 3% inflation print. If it comes in as expected, or worst case comes in higher or hotter, it's probably not a good thing. And Powell's going to say the same thing he always does. We could raise, right? What we could watch for, and let's do this before we go. Screenshot of the watch tool, because Monday the 8th. Let's timestamp this. If this changes by Friday's session, it's because of all the data that came in this week. So it's not this that I'm interested in. It's going to be September. And Benji, I don't know how bad the snoring is, but it's 2 feet away from me. Hopefully you can't hear it. Probably can though. Okay, September, 72.5%. This has even gone up higher than last night. This was at 70.8 last night. Now it's up 72.5. So the probability continues to grow that the Fed is going to cut in September. So take a screenshot right there. And then there's one more thing I want to show you. Okay, so we had talked about this stickiness, the market's, oh, cool, lowest in 5 months. Well, we're the same. It's the same freaking reading. Year over year has been the same. 2.9, 3.1, 3.5, 3.4, 3.3, 3.2. It's the same. This is sticky inflation. So I realistically think that we need to have a sub 3% print in order for the market to be like, okay, cool. Additional cooling and inflation pressures, the Fed's likely going to cut. Okay, this is another thing that's a little staggering. We have unemployment rate and non-farm payroll. We have unemployment rate creeping up to 4.1. Okay, we've had a rolling 12-month look of unemployment creeping up by 0.5%. Now, I've said all year that one recession indicator is when you see unemployment percentages tick up in a 12-month window. If it's a rolling 12 months, if it ticks up over 1%, that has been automatically a recession indicator. We're up 0.5%. Okay. That's not nothing. So something to pay attention to is non-farm numbers have cooled off. We are still adding jobs, but we're tapering off and we're slowing, and unemployment rate is ticking higher. So, do we have a softening labor market? Yes. Is it potentially a concern? Maybe. Right? Housing unaffordable. Wages aren't. Wages are not keeping pace. Okay. Inflation's. People are saying, "Oh, it's 3.1%." It's more like 20%. If a gallon of milk was $4, now it's $5. That's a 20% inflation price tag, right? Our wages have not gone up 20%. Our wages have not gone up 50 to 100% to maintain, house buying power, because we're at these unaffordable levels right now. So something that's definitely happening, on the surface, underneath the surface, that is a bit of cause for concern. And this is what the Fed is going to have to navigate. And then we'll make a mention of this: 72.5% probability that September's decision is going to be a cut. Now, with CPI data this week, with PPI data this week, with the Fed talking, Powell talking, does this change? Is there any type of hint of his comments this week, or any type of hint with the market this week, that this changes? The Fed, the FOMC is not till the end of the month, right? And then we have 0 in August, which is going to be about Jackson Hole in the middle of August, and then September is going to be where all this happens. And so if all the good is getting priced in, this is where it potentially is buy the rumor, sell the news. And I'm not calling a top. I think that's the dumbest thing to do, because the market can have a dip and pull back in September and then have a great rip in Q4, and it's the same it always is, which is Q4 is historically very bullish. But if there is all this good stuff that's being priced in with uncertainty and volatility around the election, I think for me, it is worth it to trade inexpensive hedges to make sure that I can maintain some profits for the year and then continue to do my best to generate income. Pretty simple stuff. Okay. So we'll talk more about that this week in the trading rooms. We'll certainly talk about that, on Friday, if you have some questions you want to carry this conversation on. But I will see you in Discord. I'll see you in the live sessions. Let's have a great week. It's nice to be back. More holiday disruptions, and it's a big week. Okay. All right. Take care, everybody. See you soon. Thanks. Bye.